Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Data delayed. The all-important U.S. jobs print getting hit by the federal government shutdown. President Trump vowing thousands of job cuts, ramping up the pressure on Democrats to end the impasse. And on this side of the Atlantic, French Prime Minister Sébastien Lecornu is set to meet with lawmakers for crunch talks today as he struggles to pass a budget and stay in office. Plus, Vladimir Zelensky says Ukraine may be able to acquire long-range weapons to strike Russia after talks with European leaders in Copenhagen. We'll dive through the details and some of the other incursions in Europe, Guy.
Keeping an eye on that. 59 minutes to go until the market open here in Europe. Normally, we'd be talking about what is happening with the US data, but we don't have that. This morning, we are reasonably becalmed when it comes to equities, which is interesting. Euro Stoxx 50 futures and S&P futures up a little bit. They're up a little bit, but not by much. Asia has rolled over, which is also interesting. The AI trade beginning to fade a little bit out of that market narrative. Dollar yen is actually on the front foot, so the dollar's coming back a little bit, which is interesting too. You've had comments from UADA this morning, and Bitcoin at 120. So we've been over the 120 line. We're fading that now. We're kind of 119, 120. Remember, we haven't been at 120 since the record high that we hit some 7 weeks back. So that's interesting as well. And just in terms of the symbolism that we see around that story, the correlations we see around that story. So we're down by 0.6%. Despite the data, it's going to be an interesting Friday. The countdown to the opening trade starts right now. Friday morning, good morning. First Friday of the month. Normally, I'd be starting the show saying something like, it's Jobs Day in the USA. But we can't do that today because it's not Jobs Day, it's Shutdown Day. And the shutdown continues and the expectations are it could last a little bit longer. Both sides, Kriti, are hunkering down.
It's fascinating here because there was an expectation in the markets, there was an expectation in Washington that day three, there would be some sort of negotiation, some sort of conversation, some sort of movability, if not on this shutdown, that even the discussions that are going to happen in November or December, should we get some sort of short-term funding bill. None of that is happening, and the markets are indeed getting nervous. You don't see it in the stock market. You see it in other pots. You see it in gold. You see it slightly in the bond market. You're starting to see jitters when it comes to credit default swaps ticking higher, not by a massive margin, but just a little bit.
So reading the US papers this morning, I think, is really interesting. The Washington Post talking about the idea that actually legal minds within the administration are just quietly warning the administration that firing huge numbers of people may not actually be legal. So maybe you don't want to go down that road. The Journal is leading with an article talking about the fact, well, not leading, it's got an article talking about the fact that actually the Trump administration is getting nervous about the fact that cutting health care could be something you don't want to do going into the midterms. A lot of Americans are quite pro their health care that they have at the moment, and drawing that down would potentially cause political problems. So some of the threats that maybe the Trump administration is posing at the moment aren't real, and the Democrats kind of feel like they're calling the bluff at the moment.
We should just explain to our global audience this healthcare debate briefly, because Americans don't have health care the way you do in Europe. And this is a key voting issue. It has been a key voting issue, how expensive things are getting. The problem is that some of these tax incentives, but also extensions and subsidies and extensions are from Obamacare, from the Affordable Care Act. So this is a Democratic cause that's actually been making things cheaper. On the one hand, if you extend them, it could help Americans, but you're supporting a Democratic cause in theory. On the other hand, you don't extend them, you support the GOP cause, and at the end of the day, things get more expensive, which could, to your point, haunt the Republicans at the midterms.
And that's going to be really, particularly the race for the House, really tight at the moment, so they're paying attention to that. Let's talk a little bit about what's happening in France, talking of politics and what is going on right now. So the new Prime Minister, Monsieur Lecornu, is going to have fresh talks today with the socialists to try and figure out a way to get some sort of tacit approval to get some backing for a budget, which he has to deliver going forward. Remember, we still don't have a government fully formed yet in France. He has to get these talks underway. He has to get some sort of breakthrough with the socialists, because it's unlikely he's going to get a breakthrough with the right. He has to basically get the process underway by October the 13th. Otherwise, we're going to see problems. Effectively, we're going to end up in a position where we may have to roll this year's budget into next year's budget. We've done that already. Beirut did that already. The socialists said yesterday they're going to give them a chance, but it feels like, again, France is teetering on the edge of yet another government failure, which would be the third in a year. And how much longer can this process continue for?
Quite literally deja vu. Michel Barnier is somewhere, I think, laughing at what's going on, maybe feeling a little bit validated in terms of how his time in office ended. I'm sure Francois Bayrou, I've had to think about that for a second, is also feeling the same way. Well, exactly. You kind of have to go through the roster. But this is fascinating as well because, again, because we're seeing deja vu, there is a sense of complacency in the market when it comes to this particular issue. We're not seeing spreads widen. We're not seeing the euro weaken at all. And I'm curious what gets us to that point when things already feel very dire in the political space.
They do feel very dire. And the compare and contrast with Italy is fascinating. So Lecornu is warning that basically we could end up with, if we have to roll the budget, and I've been trying to figure this all out with Alan Katz this morning, he's been setting me straight. If we have to roll the budget, as Beirut did, this budget into next year, Lecornu is warning that you could end up with a 6% budget deficit. 6%. That compares and contrasts with Italy, which is now at 3%. So that gap between France and Italy starting to look really interesting, just from a deficit point of view. And at some point, to your point, maybe that spread, which is quite tight at the moment between Rome and Paris at the moment, starts to actually move further away from France and get away from France. And the bond market kind of creeps towards that narrative.
What does the rest of Europe take their cue from? From the Italian refinancing story or from the French chaos? I'm very curious about that.
Well, one's acute. The French story feels acute. So the Italian story has been kind of a slow burn, but we've had confirmation of it this week with the budget. But the French problem appears acute. And to your point, the market has reacted, but kind of very incrementally. At some point, do you get to a kind of a moment of crisis, like proper crisis, a market crisis? But we're not there yet. You do wonder what the catalyst for Europe is going to look like. I read the headlines this morning. Okay, you come in and you're sitting there in the car. You're trying to figure out exactly kind of what's going on. You wake up first thing in the morning. The picture looks like this. You've got an incursion into Poland. You've got this story around Munich. Is Europe at war already and we just don't know it?
It's starting to feel that way, but we're not there yet because some of these budget issues, to your point in the second agenda item, it leads us nicely to this defense conversation because Italy is dealing with its budget story, but it's also still investing in defense in a really, really big way because of these security issues that you laid out. To your point, these drones that have been put in Munich, there's a speculation.
Munich airport's closed. Munich airport gets closed because of drones. We've seen this in Denmark. We've seen it in other countries. That is somebody sending drones potentially into Germany, which is like a fairly big step in my mind.
A fairly big step. The closest, I think, west that we've seen in recent days, or recent weeks, I should say. At the same time, the conversation over in the States seems to be, do we start talking about long-range missiles? There's reporting suggesting that Zelensky is getting the nod, not just from the White House, but from some of the meetings he had with European leaders in Copenhagen.
But that now starts to feel symmetrical, doesn't it? And we don't know where these drones have come from. But you've got a Russian ship also very close to a key piece of gas infrastructure in Poland that we're watching carefully as well. But you're basically shifting the relatively narrow theatre further east and further west. Further west into Germany, into Denmark, further east into Russia with these longer range weapons. This conflict is expanding. In terms of its geographical nature. It's pulling more and more countries in. It's having a direct impact in more and more countries. And that is something that it feels very incremental, but significant.
But to your point of the geographical expansion, it's also going into different areas. Oil tankers with France as well, where France detained one of the captains of an oil tanker that has been suspected to be skirting some of the sanctions around Russia. And now France holding that accountable in international waters.
Putin is now saying that it's piracy. That's another kind of element in terms of this theatre expansion that we are seeing. So the war feels like it's getting bigger. And you do wonder there's going to be a sort of point in time where Europe goes, we're at war, but actually we've realised that we've been at war for quite a long time. And you do wonder whether we're in that kind of grey area right now. What have we got coming up on the show? Plenty to discuss. Barnaby Wager, UBS's chief strategist, is going to be joining us as well, as will Hugh Van Steenis, Oliver Wyman's partner at Oliver Wyman. I think both of these conversations are going to be fascinating today. There's so much that we need to talk to both of these two about. And you've had a busy 24 hours.
I've had a busy 24 hours, an exciting 24 hours, and it continues. The final countdown, 7 days from today, we should get maybe some sort of certainty when it comes to the biggest banking deal at the moment in Europe. We're going to hear from the two Spanish banking giants at the helm of it, BBVA's chairman, Carlos Torres, and, of course, the Sabadell CEO, Cesar González-Bueno, joined me for exclusive conversations, walking us through where we are in the deal, how close they're getting, what they're looking to do. We walk through a lot of hypothetical scenarios about how this moves forward, but the things that are making the markets jittery, because it could go in either direction. There are institutional players involved. There's a mystery Mexican billionaire involved. There's a very strong retail base in Catalonia involved. This has truly turned into a telenovela, and we've got the exclusives right here on the show.
Looking forward to hearing those conversations a little bit later on, and it's kind of a moment in time, I think. Europe is struggling to get cross-border deals over the line, but just the fight to get a Spanish deal over the line is absolutely epic.
Absolutely. No, it's certainly a fascinating one. It brings about so many political, economic, even inflationary consequences. We'll dive into those details later in the program. In the meantime, some data that I want to put on your agenda at about 9 a.m. UK time, saying just under 2 hours. Euro area final PMIs are going to be hitting the wire. We should point out, as Guy said, it is not jobs day in America. Non-farm payrolls are indeed delayed. 3 p.m. UK time, U.S. ISM services, however, will be hitting the wire. We're going to get some Fed speak as well tonight, this evening.
If you're call it NFP, not non-farm payrolls.
That's juicy. That rolls right off the tongue.
Easy to say. I actually had to think about it before I said it. What else do you need to know this morning? UK counter-terrorism police have named a British citizen of Syrian descent as the perpetrator of an attack on a synagogue that killed 2 people yesterday. 2 men died and 3 others sustained serious injuries during the assault on the temple in Manchester, where worshippers were gathering for Yom Kippur, the holiest day in the Jewish calendar. Police said the attacker drove a vehicle at people outside the synagogue and then attacked them with a knife before being shot dead by officers. Bloomberg understands that Bridgewater's flagship macro fund climbed 26.4% in the first 9 months of this year as tariff-fueled market uncertainty boosted the firm and its peers. Sources say the hedge fund is on track for the biggest gains since 2010. The 50-year-old firm has been in reboot mode since Nir Bardea became sole CEO in 2023, making sweeping personnel changes and cutting assets in a bid to boost performance. And Bloomberg has been told that Boeing's 777X is now slated to fly commercially for the first time in early 2027 instead of next year, 2026. Now, this, of course, sets the stage for potentially billions of dollars in accounting charges. The delay could impact customers, including Lufthansa. Tim Clark over at Emirates has been a big buyer of this aircraft. The jet is already 6 years late and has major strategic and financial importance to Boeing. So this is, in some ways, you can think about this jet as almost a replacement of the A380. It is absolutely enormous. The commercial world has been waiting for this for a very, very long time. It's big operators that need this aircraft. Tim Clark at Emirates has been buying an awful lot of them. Lufthansa, various others that have had slightly older long-haul fleets have been big buyers. Boeing's in a really difficult position. It needs to get this aircraft out there because obviously you need to pay for it. At the same time, we learned earlier on this week that it's also trying to finance and start the process of building a replacement for the 737, which is going to be kind of strategically difficult and commercially expensive. So Boeing, the team over there, Kelly Ortberg and the team, juggling a lot of balls at the moment. And they also, at the same time, also need to raise the production output of the current narrow body, which is the 737. So an awful lot going on. So the challenges are absolutely enormous. But this thing is huge, and like it's a twin engine rather than a 4-engine 380, but nevertheless, kind of there aren't many buyers of it, but the buyers that need it really need it.
It's fascinating to see what that timeline actually looks like. I think Danny Lee is going to join us later in the program to walk us through some of the details. I think it's been a successful morning. I've nerded out about Spanish banks. You've nerded out about the airplanes. We're off to a good start.
Coming up on NFP to talk about. So.
This is what happens on a no-jobs day. Coming up on the program, we're going to keep a close eye on defense stocks at the open. A series, as we discussed, of airspace incursions across Europe. Germany, the latest country rumored to be hit. Plus, BOJ Governor Kazuo Ueda keeps his policy options open by reiterating the bank's long-held stance on interest rates. We're going to dive into the details. Paul Dobson, our Asia Markets executive editor, will join the program. Up next, though, we're joined by Nanette Hetchler-Federb, CIO for EMEA over at Lombard Odier. We're going to talk about this bond market and the shutdown impact. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
It's a little bit like the Blazing Saddles. They've got a gun pointed at their own head. They're the chief executive officer of the country, right? They're going to need people to run the programs that reflect their priorities. So, the threat to fire people who would help them implement their agenda seems a little empty to me.
That's kind of the tone that I'm getting as well from some of the papers this morning. Jim Milstein, the Guggenheim co-chair, talking to us about what is happening with the shutdown. The polymarket odds of a shutdown lasting to October the 15th, rising quite rapidly over the last 24 hours. And one of the factors that is maybe causing both sides to stand off here is healthcare, which is what Kriti is watching this morning.
I am. It's fascinating because it's something that has been such a sticking point in Washington for such a long time. But there's an economic impact here. Things are expensive. It was a key voting issue when it came to the very last election. Things are expensive. People don't want to pay for it. It's actually the drive to push down drug prices that you saw from the Biden administration and now from the Trump administration as well. This chart's a little messy, but stick with me. This is kind of the dynamic I want to walk through because one of the key pieces of the shutdown, stare down, basically, is this extension of healthcare subsidies that is part of the Affordable Care Act, otherwise known as Obamacare. It's a Democratic issue that has actually been pushing prices down. The extension of those subsidies is what Dems are pushing for. Republicans don't want that. This is where this chart actually comes into handy because it talks about the inflationary pressures here. This yellow line is headline CPI. That's our regular inflation number. The white line is medical care services, which are starting to tick a little bit higher. Drug prices are in the blue. And you can start to see that the drug prices are actually pulling the headline inflation number down. But the services are where the tick higher is. So, Guy, the risk ultimately is that if you don't get these extensions either into the end of the year or into next year, does this number, does this white line suddenly spike much, much higher?
Yeah, just another factor which could fold into the inflation narrative in the United States. We were talking about it yesterday with electricity prices. There's a number of factors just coming together to maybe drive that story higher. And that's certainly something that we need to fold into the Fed conversation, a conversation which doesn't include the latest data on the labour market, which is making life a little bit tricky for the markets and the Fed as it thinks about what happens next in terms of where it goes with policy. What has been interesting this week has been that actually what we've seen is that US assets have underperformed European assets this week. Is that related to what we are seeing in the United States as a result of this shutdown and the implications that we are going to be watching? What happens next? Nanette Hetchler-Federb, CIO EMEA at Lombard Odier, joins us now. Good morning. Do I stay away from the United States because what is happening in Washington right now? Is that a reason to avoid U.S. assets?
I don't think you should be associating those two. We've been looking at prior shutdowns, and actually the S&P 500 after those shutdowns over the coming months had in general a good run. I think the reason why we are a bit cautious on U.S. assets, U.S. stocks, nevertheless ourselves, is another one. It's just that valuations have again soared to levels that are quite expensive and that we are finding some better alternatives elsewhere.
Where are the better alternatives? Are they to be found in Europe? Because I'm also reading a lot of stuff about emerging markets. If you want to diversify away from the United States, where do you do it right now?
Yes, emerging markets are really at a point in the interest rate cycle in the U.S. actually where they're benefiting. Emerging markets do well when the U.S. Federal Reserve is cutting interest rates, and if anything, the government shutdown at the moment, the longer it takes, is likely to make it more likely for the Fed to continue cutting interest rates out of the precaution that they have adopted. This is all good for emerging market equities. There are some exciting stories obviously going on in emerging markets as well, in technology, for example, in China. And so this is one of the beneficiaries. The other regions in Europe that we find could be at a moment where they can play catch up are markets that are much more niche, that are, for example, the Swiss equity market, who have such a strong exposure to pharmaceuticals, to the healthcare sector, where peak uncertainty may be past.
Nanette, when it comes to the shutdown case, we've heard two different narratives. That one, it could just a prolonged shutdown if it closer to the 35-day range, for example, where the government stays closed, as we saw in 2019. That could actually reinvigorate the Sell America trade and perhaps even benefit the Buy Europe trade. The opposite is that maybe you see a repeat of 2011, where bad news in America just means you go and dive into the safest sectors in the States. What side of that narrative do you stand on?
I think the one clearest side is to expect U.S. Treasury yields as a result to continue falling. We've seen a significant decline of yields on the back of this story. I think this is reinforced. We should be expecting that U.S. 10-year Treasury yields fall beneath 4%. This is backed by the macroeconomic developments that we are likely to see. And then as far as equities are concerned, I think that we should be expecting now noise in the macroeconomic data. And so I'm really looking for catalysts of regional preferences a bit elsewhere. For example, in valuations, in earnings that are going to show the trends of the next quarter.
Nanette, can I ask you a relative and absolute question? I appreciate that there is a desire currently for diversification because the US market looks expensive. And many people I'm having that conversation with at the moment. The issue is this a relative conversation or an absolute conversation? If the US market goes down, I'm assuming that all other markets correlated will go down as well. The correlation is there. So is this if I hide out in emerging markets or Europe or wherever else it is, am I still going to see potentially a negative performance if the US market rolls over at this stage? Or am I still actually going to benefit from that trade? How are you thinking about it?
I think this relative view of what market is likely to do better than another is really helping active asset managers or wealth managers to try and get the best out on behalf of their customers and of their investors. For the overall, the absolute side, is an investor likely to benefit from being in equity markets altogether? I think that the overall economic environment continues to be really key. The U.S., by its size, is going to play an important role in that. And for now, it seems as if the lack of recession risks and the surprisingly good state of the U.S. consumer through all these uncertainties and headlines is boding well for equity markets to continue playing a positive role in assets, in portfolios of investors.
Yeah, and Europe looking like it's beginning to break out a little bit from its recent ranges. Nanette, great to see you. Thank you very much indeed for joining us. Nanette Heschler-Feder, CIO EMEA at Lombard ODA. A little later on, we're going to carry on the conversation about where we go next with the Fed's Stephen Miron, Fed Governor now, is going to be joining us. That conversation, 2:30 p.m. London time. But we've got more before we get to that.
Before we get to that, it's my favorite topic, Spanish banking exclusives. We'll hear from the CEO of Banco Sabadell and the chair of BBVA, the takeover battle. Just a week left. Those interviews next. This is Bloomberg.
30 minutes to go until the opening trade here in Europe this Friday. Are European equities finally breaking out of their recent ranges? Key question this morning. It looks like it. Take a look at the long-term chart of the Stock 600. We're now trading, coming into the close yesterday, 567. That's where we're kind of coming in this morning. Looks like we're breaking out. Are we? I think that's a key question. Let's talk a little bit about what we're seeing in the bond market this morning. You've got the opening trade already underway there. What is interesting here is that you've got Italy trading inside of France. Look at that. 525, 515. Italy, 3% budget deficit. France potentially heading for a 6% budget deficit. That is something you want to pay attention to. But let's head further west. Let's talk about what is happening in the banking sector in Spain. The BBVA chair and Sabadell CEO have been speaking to Kriti over the last 24 hours. They're seeking to sway investors, of which stripe we don't know yet, but Kriti's going to tell us in a couple of minutes about a takeover fight that is fascinating. Kriti, give us the skinny here. What are we watching? Give us the takeaway from these amazing conversations. 2
exclusive conversations with Bloomberg alone in the final days of the deal. We are 7 days away from this deal deadline, and this is what the number looks like. This is what the takeover offer looks like from BBVA. One share, forget this, I'm going to get this number right, 4.8376 shares of Sabadell. A deal valued at about 17 billion euros. When we started covering the story about 17 months ago, the deal was valued at about 14 billion euros. So this is an offer that's improved by about 10%, give or take, and met with a series of dividends, a series of buybacks, not to mention a TSB sale from Banco Sabadell to Santander, all roped in there. This is where the shareholders really carry all the weight. And this is the institutional piece. We'll get to the retail in a moment that really matter. I'm going to start over here. Zurich Insurance, a key player here, has actually been buying shares of Banco Sabadell. They are a key partner when it comes to Banco Sabadell. And one of the key concerns here is that if ultimately BBVA is able to conduct this takeover, Zurich may not have that deal agreement. They want that access to the Spanish market. This is a similar story with Amundi. Together, these two firms own over 6% of the Banco Sabadell share base. BlackRock as well, of course, they own a little bit of everything around the world. You need them on your side to see this go through. This is my favorite bit, though. The Mexican billionaire, the mystery Mexican billionaire, David Martinez, who has been a bit of a anomaly when it comes to the stance that the Banco Sabadell board has when it comes to this. He actually said, I will tender my shares. I will leave Banco Sabadell. I will take BBVA at its word. Algebris Investments as well has also said yes to BBVA. I think what's interesting about David Martinez is there's now some speculation about whether he could have some sort of bigger role in the future entity if this takeover goes through. But it's not just the institutional that matters. In fact, it's the retail-based guy that matters most. And that's where this chart is really, really crucial. These are figures provided by Banco Sabadell in terms of who actually owns those shares. About 40%, over 40%. By just the retail base. And it's not just retail. It's not your meme stock fans. It's the retail base who are clients, largely clients of Banco Sabadell, who have inherited the shares from generations, from their parents to their grandparents. There is concern here that there is a sentimental kind of holding in some of this stock holding. And that's why there may be some resistance for BBVA to actually be able to convince them to tender their offers. Nevertheless, it's not just retail. You have the institutional, you have the passive and the active as well. There's plenty of folks, but this is a really interesting takeover story in terms of whether or not they can hit the 50% threshold they need to actually execute this deal. I asked BBVA Chairman Carlos Torres Villa about what would happen if you don't hit the 50%. This is what he had to say.
If we were to waive the condition, we would need to launch a second offer at the same price in cash. So it would be actually what the law says, it would be the highest price BBVA would have paid in the prior 12 months. So that would be the price of this offer, just in cash. So that would be the situation. And yes, the math depends on whatever take-up happens after that. So what's the take-up in the first one and what's the take-up in the second one, given that they are the same price? So you can make your hypothesis, but again, this is very hypothetical terrain.
Well, as you can imagine, investors around the world are exploring all of the hypothetical options, especially your investors and, of course, Sabadell's investors. Is that a conversation you've had in terms of what you just laid out with the CNMV?
Of course, the CNMV has approved the prospectus, so all the options that are laid out in the prospectus, which are the ones I'm commenting, are very, very clear. Regarding conversations with investors, I think there has been some confusion in the messaging that has been coming to investors, particularly the retail ones, regarding the fact that maybe it's better to wait for a second offer. Nothing of that sort. So it makes really no sense to wait for a second offer, which would be highly uncertain, because it would entirely depend first on the take-up. So if we're above 50, it doesn't happen. If we're below, it entirely depends on BBVA's will to proceed or not. And of course, we would make the decision based on our shareholders' interests always. But even if it were to come, it has no added attractiveness versus the current offer, because it would be at the same price. It would be a few months later, so why wait if this offer is on the table right now and you can seize the opportunity right now? And finally, it has a worse tax treatment because it would be a cash offer.
Well, Carlos, let's talk about some of the reasons not to take the deal. And this is something that's being floated around in terms of some of Sabadell's shareholders, which is that there has been a promise from Sabadell leadership of a special dividend to the tune of 2.5 billion euros, extra money that's come from the TSB sale that the leadership over at Sabadell has promised to the shareholders. Is that a promise you can compete with? If not now, then if the deal goes through?
Well, as shareholders know, dividends themselves represent cash back to shareholders that already owns to the shareholders. So you're only giving yourself, or you're giving your shareholders what they already own, and that's why when you pay a dividend, the stock price corrects down to on the amount of the dividend, because it's a distribution. So the focus should not be on distributions, particularly of extraordinary nature. When you're selling a piece of your business, you're selling an asset. As important as TSB was for Sabadell, that generates cash that you give back. But the giving back itself is not a value-generating move.
BBVA Chairman Carlos Torres Vila, they're talking about the fact that this buyback, this dividend, the shareholder return is a strategy that Sabadell uses, but that BBVA would not. 50%, that's the threshold. We posed the exact same questions to the Sabadell CEO, César González-Bueno. Take a listen to what he had to say.
I think there's a high probability that they will, but of course that it's only for them to say. But their persistence, sometimes beyond what was expected in terms of continuing with this deal, tends to show that it might take them to make the decision, even if they are in the low 30s, if that would happen in terms of acceptance. And the 50 is unattainable for a very simple reason. 40% to begin with. This is the major argument. There are others. More than 40% are retail. If you wanted to know the acceptance level up to today, it's below 1%. And those don't do it the last day. They do it in a gradual manner, and they have been doing it into a gradual manner over the course of the days, and they remain still below 1%. The 80% of which we have knowledge, which are at the same time our customers, and at the same time our shareholders with more than 15 years of average tenure of our shares. And those are not going to tender. And then, of course, we all know the composition, and we are sharing it with the market, and the market has come to the conviction that reaching the 50% is impossible. Furthermore, they said that they would never go below 50, and now they have opened lately that possibility, and they acknowledge that reaching the 50 is very difficult just by their own actions. They have lowered the threshold to 30.
They have said that that is a possibility. They haven't actually made that change just yet. At the moment, the threshold is still 50. But to your point, they do have the legal ability to do so. Let's explore the hypothetical scenario that were they to move that threshold lower to 30%, include that second takeover offer. Is there a price in mind of what that second takeover offer would be?
There's a huge discussion. What there is certainty is that there is uncertainty of what that price would be. What the chairman of the CNMV, which has the ultimate word, has said is that it will be equal or superior to the first offer. Therefore, waiting has a tremendous incentive, even for those who wanted to tender, because they would have not only a potentially higher price, but furthermore, they would have what in financial terms we call a put, which is the ability to tender in the course of 3 or 4 months at a fixed price. So if the price goes down, they will all tender if this second option occurred, and if the price of Sabadell shares went up, no one would tender. So that means that they would even end up at the low end of the 30s and then have to move through in order to get a potentially higher shareholding, which adds even more risk, or that they might have to put on the table up to 12 billion in cash.
Sabadell CEO Cesar González-Bueno there speaking to us in an exclusive interview. You can get the full conversations. We went through a lot on Bloomberg.com. But, Guy, I think the takeaway for me here was this could really go in either direction. Yeah. I think throughout the 17 months that this deal has been going on, there's been indications of which way it would lean. We're 7 days away. It is in the hands of the retail shareholders, basically, and whether or not BBVA can make their case.
You wonder how clean it will be, given the kind of the difficulty of getting this thing over the line, how clean it will be if there was a deal done.
Yeah.
Kind of what would that look like in the aftermath of that deal getting done, and how everybody would feel about it. I think it would be fascinating. They also come back to the conversation we had earlier, which is I'm beginning to wonder whether actually domestic deals are going to be harder than doing cross-border deals, because this domestic deal and others like it have been really hard to make work.
And I'll just remind our global audience, even if this deal goes through, Carlos Cuerpo on this very program, the Spanish economy minister, made it very clear that this would only be kind of a holding company situation. They can't actually merge for anything between 3 to 5 years, and they can't let go of their labor force. There are a lot of restrictions, even if this deal goes through.
One deal that we're watching very, very carefully as we continue to see how European banking is going to develop. Remember, European banking, the sector as a whole, has had such a great run of late and continues to be a prime driver of what we're seeing in European equity markets as they break out. We're going to carry on the conversation, the fantastic conversations we're having here at Bloomberg on the banking sector. We've got a conversation coming up with the chief executive of Goldman Sachs. Tom McKenzie will be speaking with David Solomon about the impact of AI on building financial infrastructure in the future. That's 9:40 a.m. with Tom McKenzie and David Solomon. Looking forward to that, a great deal.
Absolutely. Certainly, we'll all be tuning in for it. Coming up on the program, we're watching defense stocks today after a series of airspace incursions across Europe. That and your other stocks to watch next. This is Bloomberg.
Friday morning, good morning. 14 minutes to the market open. Keep an eye on defense stocks this morning. The reason I say that is the perimeter of the Ukrainian conflict keeps getting bigger and bigger. We've had Munich airport being closed as a result of a drone strike. We're incrementally moving the conflict into Western Europe. We've also got this story that we're following here at Bloomberg about the possibility of Ukraine being given US long-range weapons to strike further into Russia. The conflict is widening. The perimeter of the conflict is widening. Piotr Skolomowski in Warsaw joining us now to talk about this. You've got this unspoken war, which the Polish Prime Minister is now talking about. Poland saying that Europe is already effectively at war. And given what we've seen with Poland and this pipeline, we've got a Russian vessel near a key Polish pipeline, and also what's happened in Munich, and also these long-range weapons. How true is that comment?
Well, it's very true. I mean, what obviously the Prime Minister referred to, or his spokesman actually, is that, we're talking about a hybrid warfare, which is, we're sort of not really in direct conflict, but all these, like the collection of all these events that are happening, and that's been affecting the eastern flank mainly, but it's, as you said, it's spreading westwards right now, that we are in a situation where we are effectively, or as a region, in a conflict with Russia. At the same time, Russia constantly denies any kind of attempts at trying to disrupt functioning. And I think the disruption is the key word here, because, as you said, we are seeing a lot of drone sightings right now that are disrupting flights. So we've seen this more recently today, overnight in Munich. But we've also seen these recently in Denmark, in Norway. In Denmark, just as the ministers, EU leaders were meeting for the summit, for informal summit, to actually discuss security, there were a number of sightings of drones that disrupted flights to major airports. And more recently, yesterday, we heard from Polish Prime Minister, who said there was an incident near Szczecin, which is a port very close to German border. Then we learned about another Russian vessel being spotted next to the gas pipeline, and basically Polish border guards told the vessel to leave the waters. They were very close to the pipeline that basically carries gas from a rig to inland. So we have a full collection of all these events, and it's at the same time Europe is struggling to actually respond, because one, there's this whole discussion about the drone war, which is very difficult to define, and they're really struggling to find sort of a right scenario of how to build this architecture, how to combine air patrolling, which is happening over the Baltic Sea. So there's a lot to discuss. At the same time, these events are sort of under the radar in a way. They're not direct involvement of the Russian state, and the Russian state continues to deny that they are even behind that.
Bloomberg's Piotr Skalimowski joining us from Warsaw, walking us through some of these details. We thank you so much. Let's go from the geopolitics to the markets and bring in our very own Paul Dobson, executive editor for Asia Markets. Paul, we have to start with the geopolitics here because there's a lot of them, as we were just speaking to Piotr about. Does the shutdown risk trump all of that? Pun not intended.
I don't think it matters really very much at all from what we're seeing so far, Kriti. If you look at global equity markets, they just continue that march higher. It's really all about this AI trade and AI enthusiasm, and we're feeling that particularly strongly in Asia this week. We've had Sam Altman from OpenAI kind of moving around the region. He went to Japan. He's like a wizard with a magic wand, touches a few companies. We get some rallies. Hitachi today. Before that, he was in South Korea, same sort of thing. You know, there's all of these little tie-ups and deals that we're seeing. There was another one in Japan today, Fujitsu, with Nvidia as well, you know, giving the market that kind of continual sense of optimism that is getting excited about the AI. And on the infrastructure side, we've got a $40 billion deal going on as well today. You know, all of this is continuing to push up those chip stocks, the tech stocks, and continuing to perpetuate that rally. And I really think the market's more focused on that than they are worried about the geopolitics just at this moment.
Just give me it's amazing, the offset that AI is providing in terms of the momentum, plus also the kind of the passive flows that we're seeing all around all of that. Paul, just give me a sense of what is happening with Japan at the moment. I saw you made this comment a little bit earlier on about what's happening with the hard data. Can't wait for the hard data, need to get on with it. You've also got the LDP election coming up over the weekend. How much potential is there for volatility in Japanese assets as a result of some of this?
I think that the market and hedge funds in particular are quite interested in what's going to happen with the leadership vote for the LDP, because there's quite a big difference between the potential candidates who could win here. If we have Takaichi, she may be you know, more favourable for the equities market, but the view is that she's a little bit like a Liz Truss kind of a figure. You know, more spending, would prefer the central bank to be more on the dovish side, so it might be not so good for Japanese government bonds, even though it might weigh also on the currency. Whereas, you know, if we have somebody else coming through, they may be kind of more of an opposite view of that. And then we have Hayashi, who's like the third person in the race at the moment. But because of the complicated way that the votes work, it partly depends on party membership, partly depends on the lawmakers who are in power. There is that path that we've seen before where the person who's the most centrist is the one that actually comes through. In which case, you know, markets might breathe a little bit of a sigh of relief, and that might damp some of that volatility.
All right, Paul, walk us through then what the next, I want to say, 7 days looks like. As we see more of these geopolitical headlines, more of the defense headlines, a prolonged government shutdown, is that a positive or negative for U.S. assets from where you are?
I think that, you know, the longer the shutdown goes on, the more of a negative it's going to be for U.S. assets. That's the thing that people are going to have to be worried about. So keep paying attention to when we get signs of a deal being done.
We look forward to seeing how that all plays out. Paul Dobson, our executive editor for Asia Markets, joining us this morning. We thank you so much. Let's go from the macro to the micro. Get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's keep an eye on energy stocks today after oil fell to the lowest level in nearly 5 months. So there's a couple of reasons for that. OPEC is expected to agree to hike production at a meeting over the weekend, which is creating those concerns around oversupply. And then, of course, the political uncertainty that we've seen in the U.S. is not helping, with the U.S. government shutdown really fueling that kind of risk-off sentiment that we've seen in the market. So let's keep an eye on some of the key stocks today. We've got Eni being the outperformer, Total being the underperformer. Let's see how this shakes out here at the open with those oil stocks. Moving on to another sector that might be also on the move, which is defense, after a few stories around growing tensions in Europe. So we had the drone incursions at Munich airport, which meant that flight got suspended. Poland ordered a Russian ship to leave its waters after that ship was found close to a gas pipeline. And then we also had Zelensky saying that Ukraine might be able to acquire those longer range weapons from the US. So we've got this trio of stories, and that might get some of those stocks moving this morning across that defense sector. And finally, let's keep an eye on UBS. So some UBS funds have a $500 million exposure to First Brands, which is the auto parts supplier that went bankrupt a few days ago. So we'll see how the market reacts to that. Stock has been doing really well, and UBS has said that it is something it's still assessing the impact of. It said that it affects a very small number of funds, but we'll see how the market really reacts to that exposure this morning.
All right, our equities reporter Chloe Melly walking us through some of the stocks that could be on the move in just about 6 minutes' time. We thank you so much. There's a lot to digest today, but I wonder if any of it even permeates to the top, because isn't it Friday? It's that Friday feeling.
Should be. It should be the Friday feeling. Should be the first Friday of the month. Should be non-farm payroll day today. We're going to be watching that. It's NFP day today. The story I think that
Are you hoping that's going to catch on?
I really am. It's not going to, but it's a Friday. We live in hope. I think the real story this morning, though, is the fact that you're seeing a breakout of European equities. You take a look at the chart since the beginning of the year of the Stock 600, and over the last couple of months, you've been in quite a tight range. And we're now breaking out of that range. And is that going to be something that has momentum? You can see it on that chart there. Look at the right-hand side of that chart. Look at the range we've been in. Are we breaking out to the upside on that chart? And if we are, where does that take us? Is this related also to people diversifying money out of the United States as well as a result of the shutdown? Anyway, much to discuss. The opening trade is almost upon us. That's next. This is Bloomberg. Friday morning, good morning. First Friday of the month, normally non-farm payroll day today. We're not going to get that today. How are markets going to trade in the absence of that data, I think, is going to be quite interesting. Let's talk about the legacy from yesterday. You can't see it up here, probably because it's too small. Even I can't see it at this range. 567 is the number on the Stock 600. Are we breaking out of recent ranges for European equities, I think, is a key question. Hit highs yesterday. We faded it into the close. The US market's rallied a little bit after that, so you've got a little bit of positivity that you need to price in this Friday morning as we think about where we go. So let's take a look at the futures, give you an idea of where we're going, and the early indications out of this market look fairly positive, but not by much. We're just climbing a little bit. Stocks 50 futures up by 0.2%. FTSE's up by 0.2%. DAX futures up by 0.2%. The CAC was actually a bit of an outperformer yesterday. We're watching what is happening, though, so carefully with the politics at the moment. What's happening over in the United States? What's happening with French politics? What's happening with the geopolitics in Europe and the widening conflict? Keep an eye on defence stocks today. Keep an eye on bank stocks today. There's a lot of moving parts that we need to be paying attention to. Kriti, which stocks in particular are you focused on?
I mean, it's got to be the defense story, right? We see so many of the geopolitics. We see so many of these incursions. Does it actually serve as some sort of market catalyst? Of course, you know I've got my eye on the banking sector. BBVA and Sabadell, exclusive interviews today, 7 days until the end of that deal deadline. It is tick by tick, person by person, shareholder by shareholder. But certainly as we're going into, like I said, the final countdown, we'll see if that shows up in the markets. And of course, energy is a key focus. This week alone, that sector has been in and out of the green, a real rotation. We'll see how it ends the week today, Guy.
Yeah, there's a couple of conflicting factors in that oil market that we need to pay attention to. We'll get a take on that in a few minutes' time. But for now, it is Friday. It is time for the opening trade here in Europe. Equities get going. Let's see the kind of numbers that we're going to post. We are expecting a positive start to the day. Remember, we've been hitting records this week. We're breaking out of ranges. Are we going to continue with that momentum? The FTSE 100 maybe a little bit of a laggard today. Remember, driven earlier on this week week by some of the pharmaceutical stocks as well, which had a very kind of good midweek. Today, though, it could be defense names. We're going to keep an eye on what's happening with the oil trade as well. How significant is that going to be? Kriti's IBEX is up by 0.6%. We're watching Spanish banks very carefully following the interview yesterday. So the Spanish market, a little bit of outperformance coming through early on in that story. The DAX clearly has nothing to talk about today because it's out early in terms of posting a number. We're up by 0.4% there. The CAC is up by 0.4%. Europe pushes on. We're going to get some PMIs over the next hour as well. Pay attention to those. What are they going to tell us about the Spanish and the Italian economy as well? Fresh data coming from those markets. We'll watch that very carefully. Kriti, sectors, stocks, what are we watching there?
Well, to me, on the surface, green on the screen on the index level, but on the surface, the rotation, I think, is interesting. The outperformers of this week have been healthcare. Today, they are on the back foot. You're looking at it from an index contribution perspective. Novo Nordisk, GSK, I'm looking at Roche, Novartis. They are all in the red at the moment. Your outperformers, your index contributors to the upside, is the banking sector. I'd like to take credit for that as the exclusives on BBVA Sabadell, but I think there's more to it because we're looking at HSBC, Santander, UBS, of course, dealing with the capital rules requirements as well. They are all in the green. But again, on the surface, this feels like a rotation from some of the price action we saw earlier this week.
Absolutely. Tech is a little weaker, so ASM Holdings is the biggest drag that we are watching, which is interesting because you did see a little bit of a rollover in tech in Asia hours as well. Bob's had an incredible week in terms of the performance that we've seen there. Is that something that we're going to be continuing? But yeah, banks look like they're very much on the front foot. Banks have been the driver this year. We talk about European performance. That's where it's come from. The banking sector has been a huge part of that narrative.
Buybacks, dividends, it's kind of the Wall Street playbook, and it's kind of this kind of cycle, this self-fulfilling.
Are we
prophecy.
getting to the end of that narrative, though? Like, how much more money is going to continue to flow back, and therefore, are we going to see maybe that narrative beginning to come to a conclusion?
Yeah, we should mention as some of the defense stocks are higher as well. I'm looking at an over 3% move for Saab and some of the others. So very clearly geopolitics, the defense story showing up in this market. Let's get a little bit more analysis this morning. Banu Baweja, the chief strategist over at UBS Investment Bank, joins us around the table. Lovely to see you, as always. We've got a bear on the set for a day where all the markets are in the green. How do you explain that?
I think the data in the U.S. has actually held up better than we would have thought, right? About 2 months back, we thought the next 4 quarters are going to give us basically flat growth. Instead, growth we now think is going to be about 1.4%. So spending in the U.S. has held up, despite the fact that the labor market is very clearly weakening, right? You look at all the leading indicators in PMIs, NFIB, most of the surveys, the labor market is weakening. So there is a gap opening up between spending, which remains very strong, CapEx, also top-end consumer spending, and the labor market. So I think the key question is whether the labor market catches up to spending or spending catches down. We think it still catches down. Spending catches down to the labor market. And then the secondary question is whether tech is going to be acyclical. It hasn't been historically. It has not at all been historically acyclical, but we do seem to be in a situation in the market where we're in sort of the final throes at a time when you're getting more and more linkages between companies. M&A has picked up, and so therefore the market is carrying on putting very high multiples as well, right? So the earnings expectations, 12.9% over the next 12 months at 23 times multiples. So things are heating up a little bit. I think the economy has held up better than we expected, but the market is also putting a very high number on the earnings.
I know, guys, just jumping, ready to talk about tech. And I'm going to let him after we talk about margin compression, because we're not seeing that. The dynamics you're talking about, these jitters are very much in this market, but you don't see that in the margin compression. And I think a lot of folks would have said, it's October of 2025. It's been 6 months since Liberation Day. Where is the effect of not just tariffs, but inflation, of the volatility? Where does it show up in these numbers, or is it just getting absorbed by really rich balance sheets? Where's the pain?
I do think it's a little bit early for that, because again, if you think about inflation, it hasn't really come through, right? Neither the inflation nor margin compression have come through so far, but I think both will come through in that as these tariffs begin to hit the consumer, you'll see OER is going to stop, OER, which is the rental part, which has been completely countervailing the impact of goods prices going up. I think that's going to begin to trough out in terms of how low it can go. And that's where in the next 6 months, sort of the average change in core CPI is going to be in the mid-30s, which means it's going to annualize close to 4%. That will tell on real disposable income. That will tell on margins as well. So I'm not sure you're going to see a lot of this in the Q3 reporting season, but beyond that, I think you will begin to see margin compression as well. Margins are at sort of 95 percentile.
let's talk a little bit about this tech trade and try and get a bit of more understanding of kind of where we are within it. At the moment, it feels like where the funnel is wide, and we've got a lot of runners and riders, and ultimately there's going to be a few horses that are going to win the race. At what point are we going to know which ones are going to win the race? Because everybody's spending galactic amounts of money at the moment because they want to be the winner. But I don't know who's going to be the winner yet. Do we have any visibility on that at this point?
I mean, the question is going to be whether or not this CapEx spending in technology is going to lead to a big pickup in productivity, right? We need to see whether...
Hasn't yet.
Well, productivity has been in line with long-term averages. It hasn't led to a very big increase in productivity. And remember, in the 1990s, which is what people compare it to, Greenspan said, the data doesn't tell you that we are seeing much higher productivity, but I can tell you that there's a productivity miracle on the way. So sometimes the data does lag, right? However, I will say that if you start comparing it to the 1990s, the degree of capex, although there's some hyperscalers where the capex is very, very high and the capex to sales ratio is getting to worrying levels, if you look at overall tech, if you look at information processing, if you look at software, if you look at research and development, actually, the growth in capex spending is a fraction of what it was in the 1990s, right? And you don't have the same degree of consumer strength either. So I think when we compare this to the 1990s, and often people ask the question, are we 1996 or are we 1998 or are we getting close to 2000 already? It actually doesn't compare to the 1990s. So we don't think we are in such a large productivity boom. So to go back to your question, I think the answer really is, at what point do you start seeing non-tech sectors? So if the news is not on Hitachi, not on Fujitsu, not on OpenAI, but which healthcare company starts telling you that there are significant reductions in its COGS or significant increases in its revenues as a result of AI? I think the market has been very patient with that, much too patient. And I think through the course of this year, in Q4 earnings season, if you don't begin to see in the real world monetizable AI, I'm not saying AI is not relevant. AI is very relevant over the medium term. But by the end of this year, early next year, if you don't see AI being monetized in non-tech sectors, that's when I think the market runs out of patience.
Okay, so when the market runs out of patience, the key question then is how much leverage is there within that trade? Because leverage is what undoes these things.
Leverage is what compromises the balance sheet guy, right? So, but because we
have to write it down.
Sure, but you don't need a balance sheet crisis. A balance sheet crisis is a sufficient condition for the market to go down, not a necessary condition. In that you could have income statement problems. You could have, first, a lot of the leverage, both in credit and in equity in this cycle, is on the private side, which is why you have not seen many publicly traded companies trade poorly. So you look at high yield spreads, they're absolutely fine. You look at equities, they continue to go up. To Kriti's point, you keep getting the inflows all the time, the valuations go up all the time. So it's on the private side, and that's why the visibility of there is leverage. The visibility of that leverage in recorded data, I think, is quite poor. So you need to see profitability. And by the way, NEPA profits, which is not the same NEPA as national accounts, overall economy, which is not the same thing as NASDAQ, not the same thing as S&P, they have begun to come down, right? And that will lead profits in the S&P also hitting a little bit of a headwind. And I think that's when the private companies are going to start telling you that things are not as strong as you thought. Publicly trading companies will probably feel it even after that.
Let's bring the story here to Europe. It's a very clear AI tech case in the States. In Europe, there's been a conversation about the fact that whereas the innovation is happening in the States and arguably in Asia as well, the adoption process is faster in Europe. And you're seeing that anecdotally from some of the banks, from some of the financial institutions, from even some of the healthcare names as well. When you're trading the AI story in Europe, is there an adoption premium? Should there be?
I think it's a bit early to say that. I mean, I think the story in Europe, historically, European equities could not get off the ground if the value trade was not doing well, right? And so what has done well historically in the last 3 or 4 years has been quality, has been momentum, has been growth, right? And this is one of the reasons why Europe has lagged. Now, is Europe going to become a leader because it adopts the AI story quicker? I doubt it, right? I think the story is going to be simpler. You guys were discussing defense and you guys were discussing banks earlier. I think those are going to be the stories in Europe, particularly banks. I actually do think that banks have further to run because so far their valuations have gone from very cheap to reasonable. And also banks is one sector which is not impacted by tariffs. And this is why incremental European money, if not US money, is going to continue to go into these sectors, I think their valuations will pick up. Are they going to go up because AI is going to lead to their profitability going significantly higher? It's not clear to me that there is enough. You said there's anecdotal evidence of that. It's not clear to me that there's enough evidence that productivity in Europe is picking up directly as a result of that. So I don't think so. I don't think AI adoption is going to lead Europe to become a winner.
Can I switch gears? I want to talk about the dollar. I'm hearing a lot about emerging markets at the moment. People are telling me that's a dollar trade extension, that I should shift money into emerging markets. Dollar's going down. Does the dollar continue to go down in the scenario that you're kind of painting a picture of? And if so, what is the logical trade from that? What's the derivative trade of a weaker dollar that you think is the best one?
It's a great question. So I think when most people think about the dollar, they just think dollar down by EM, right? Yeah. We really have to ask ourselves, why is the dollar down? And more importantly, is the dollar down in a world which is a good world where volatility is compressing, or is the dollar down in a world where volatility is rising? So, you're beginning to worry about risk premia rising, because if it's the latter, and we think it's going to be the latter, because we think the dollar is going to go down, euro goes to 123, yen goes towards 135, because you get weaker U.S. growth, right? Because U.S. growth weakens. So that's a world in which VIX is higher. That's a world in which high yield spreads are higher.
Pretty low at the moment.
So, indeed. And so that's not a world in which you're running for carry. That's not a world in which you're running into Mexican peso or Brazilian real or Turkish lira, because vol is the mirror image. It's the opposite of carry.
Yeah.
So it's not a world in which you run into emerging markets. It is a world in which you run into safe havens. So gold...
Well, that's where I was going to take you. Yeah. Is gold the new VIX? Like, are people buying gold because... people aren't buying the VIX as they're kind of...
Gold serves many purposes, right? So gold is an inflation hedge. It is an uncertainty hedge. As you say, it's a volatility hedge. But also, gold, more fundamentally, gold's life changed the day Russia invaded Ukraine, because that's when many central banks, many supranationals sat around a table and asked themselves a fundamental question: what is money? If treasuries, gilts, bunds, all of that can be sanctioned, what is money? And none of them have a good answer, but all of them allocated more incrementally into gold. That's one of the reasons why gold is here. And gold's relationship with its single most important driver, which is real interest rates, completely upended that day. So that's the one place where you could continue to see further upside.
The traditional metrics don't work anymore when it comes to gold.
Indeed, they absolutely don't. But even today, you're not in a state of froth in precious metals. Silver is not massively outperforming gold. When you get froth in precious metals, silver goes bananas and significantly outperforms gold. It's very sedate. So I do think that we are still in a sort of a stage where gold can go even further. I think that's the cleanest anti-dollar trade, not the EM trade.
Great to see you. Thanks for stopping by to see us. That went by in a heartbeat.
We need like 3 days for this conversation.
Hold check. Barnaby Wager, Chief Strategist at UBS Investment Bank. Thank you very much indeed. Core 6 looks like this. Barnaby mentioning what's happening with the defence trade. Let's take a quick look at what Rheinmetall is doing. And as you can see, it is the standout story this morning. It is up when most are down. Novo, LVMH, ASML, Nestle, all softer this morning. The defence trade is on the front foot, and that is where Chloe Melly is starting.
Good morning, guys. So, let's start with some positive movements across that defense sector, as you just mentioned, with Rheinmetall, Hensoldt, Leonardo and Saab all up this morning on the back of those growing tensions in Europe. We had flight suspensions in Munich because of drone incursions. We had Poland telling a Russian ship to leave its waters, and Zelensky also saying that he expects Ukraine to secure longer-range weapons from the US. So we've got all of those stories about those growing tensions in Europe, and that is really driving the shares across that defense industry this morning. Moving on to France, where Legrand is up. Legrand provides cooling equipment, electrical equipment, data centers, and it just made a big acquisition over in the US to expand those capabilities in that market. So this is part of this ongoing M&A strategy for Legrand, and that is driving the stock this morning. Let's move over to a couple of new ratings. So Nemetschek is a company that provides software solutions to the real estate market, and it got upgraded to a buy at Berenberg. That is driving the stock up 2.6% this morning. And we also had a double upgrade from RBC for Diploma, which is a supplier of building components. And RBC said that it was one of the safest growth names in that sector, and that is driving the stock almost 3% this morning. And finally, let's end on Raiffeisen Bank in Austria. It is up as the EU is preparing to lift sanctions on assets linked to a Russian oligarch to essentially help compensate Raiffeisen for damages it had to pay in Russia. And that is driving the stock 5.4% this morning for Raiffeisen.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. As she was speaking, we did get some data crossing the wire, this time from Spain. I'm just going to run through these numbers here. The composite PMI rising to about 53.8. The forecast was 53.3. The services PMI rising as well to 54.3. The forecast was 53.3. So a slight increase. I wouldn't call it a massive.
No, but these are good numbers compared with the rest of Europe. This is the thing. The Spanish economy continues to do very well. The tourism industry, I think, circa 14-15% is a big driver of that, but it's more broad than that. And you are continuing to see the service sector as being the outperformer. Like, there's a sharp rise in new business volumes in the service sector, according to market PMI. Positive market demand. Firms also more upbeat in their assessment of the outlook. They're adding staff accordingly. Pipeline cost pressures are there, but they are underpinned by increased labour expenses, which is interesting. So what does that tell you about kind of spending within that economy too? But yeah, these are strong numbers for an economy compared with what we're seeing in the rest of Europe. So we'll come back to that. Not much movement in euro dollar, which is trading 117 at the moment, 117.23. When we come back, we need to talk about what's happening in the oil story. There's a number of different kind of factors that we need to fold in. You've got that OPEC Plus meeting we need to talk about. You've also got a big Chevron refinery flyer in LA, I think. It supplies 20% of all motor fuel in the United States, 40% of jet fuel consumed in Southern California, which is obviously a huge market as well. You're looking at pictures coming from California as we watch that fire erupt, and the implications of it, I think, are probably still to be factored in. We'll talk about it all next. This is Bloomberg. Welcome back, 20 past the hour. This is what European markets look like. It's nice to have the Germans with us today. Remember, it is reunification day in Germany. There's a national holiday, but the markets are still open. Broadly across the piece, we're up by 0.3%. European markets pushing on. We're seeing defence stocks and banks firmly in focus this morning. Let's talk about what is happening. Kriti's had her time this morning. We're going to move on now. We're not going to talk about Spanish banks. We're going to talk about what is happening in the aviation world and figure out what is happening there.
This is a fun show. We both get to do what we want to do today.
Little kind of subsections going on.
Yeah.
I want to start off with what's been going on in Munich. So flights from Munich airport have been suspended over the last 24 hours as a result of drone sightings. Now, we've seen this with other airports around Europe. It feels like this is a further expansion of the Ukrainian conflict into European airspace. Bloomberg's transport reporter Danny Lee is in London. Nice to see you in London. So that's the first thing to say. What happened here, and is it different? Are there similarities to what we've seen in terms of other airports in Denmark and in some of the other Nordics?
I think this is what officials will be trying to piece together now, not just in Germany, but across Europe, because this is now the third such airport, and particularly a major air transport hub.
This is one of Germany's biggest hubs.
Precisely. And so I think, whilst getting back to normal now, but this is a key question, is are there going to be others affected? And also, how do they prevent these kind of drone, obviously, great they see these drones, but how do they prevent them from getting anywhere near not just airports but other critical infrastructure? And so therefore I think it's going to be a question for the authorities of who do they really see as the actor involved in this, and then how do they combat it? Because whilst it's only disrupted 30-odd flights inbound and outbound, you remember all those years ago what happened at Gatwick with these supposed drone sightings, caused absolute mayhem for travellers. And obviously, as Germany heads into this holiday, people would have been getting away early for the weekend.
And we still haven't confirmed that they're actually Russian drones at the end of the day. Is that right? So we are still waiting for it. But the speculation is
I think you're never going to know
there.
the answer to that question.
I suppose that's a fair point. Let's talk about another story in the aviation space when it comes to Boeing's new 777. Is that right? 777? 777. That's the way you do it. See, this is how you know you're a novice to the aviation space. They're facing a significant delay. Can you just walk us through the impact of that? Guy was telling us earlier that this is the people who need it really, really need it. Is that fair?
Yeah, for airlines who bought into this plane, the previous decade, They were expecting this plane, this new long-haul wide-body jet, to be delivered by Boeing in 2020. So this will be a delay that now stretches into 7 years. And for Boeing, the implications are that whilst customers are continually unhappy that Boeing can't deliver, for Boeing, there could be another non-cash accounting charge, potentially between $2.5 and $4 billion. That's going to impact them. And already this program has racked up charges of $11 billion. So this is poor news for Kelly Berg, but he has been.
Is it worse for Carsten Spohr or for Tim Clark? The airlines that need them. Tim Clark is refurbishing his 380s. Is he able to carry on at Emirates with that program while he doesn't get the 777X? Because this is a huge airplane that's going to take a lot of capacity.
I think for the airlines who are getting this 777X first, they've already accounted for this delay, and I suspect, given the non-delivery of Boeing in the recent past and the failure to deliver, they have been extending the older aircraft. So I suspect they have got enough room to bridge that gap until Boeing actually delivers.
All right, Bloomberg's Dana Lee walking us through those dynamics. We thank you so much. Another story we have our eye firmly on is oil. Higher this morning, but crude heading for a decline on the week. This, of course, comes ahead of the weekend's OPEC Plus meeting. Bloomberg's Stephen Sepchinsky joins us from Singapore. Stephen, just walk us through what's at stake here. Is this just another output hike for all of us on the agenda?
I think every time we go into these meetings, there's a question as to, are they going to increase output, or are they going to increase output more than they did previously? And that's the question today, right? So there's discussion around how much will they increase. Last month, so for October, this month rather, they increased about 137,000 barrels per day. There are reports from Bloomberg and others that there's discussions of them increasing for November 500,000 barrels a day. So that'll be a ratcheting up. Now, the OPEC has come out and said that nothing has been decided yet. But the fact of the matter is the market is closely watching, and they're positioning themselves. If you look at oil prices, we're up about 1% today, but we're down about 7% for the week. That's the biggest weekly drop since June. And I think it's mostly traders positioning in the sense that, hey, there might be a larger than expected increase. Analysts surveyed by Bloomberg were expecting a smaller increase, about 137,000 barrels a day. So if they do go to the 500K, then that is bearish for the market. Analysts say that we could fall below the $60 level for Brent. We're around $65 right now.
Stephen, there's two other stories floating around in the oil market, one of which is this refinery fire we've got in California. The other one is the fact that the French have taken a Russian tanker out of the dark fleet. Neither of these two look like they're moving the market at the moment. Is the glut just so big that even factors like this aren't having an impact?
I think that's precisely it. Right, I think if we were 2 years ago when the oil market was tighter and Brent were closer to $100, if you saw a boarding and an arrest of a captain from a shadow fleet ship, which is clearly a ratcheting up against the shadow fleet, a tightening of control over what Russia and other ships can send around the world, Iran included, then that does indicate that would be a bullish indication, and you would probably see prices spike to a degree, but it was very subdued this morning. Same with the refinery fire. Whenever you see big shock and awe, one refinery out, while it is a major and one of the largest refineries in the United States and a big supplier for Southern California, a refinery fire does tend to lead to knee-jerk reactions, and it would be, you would sort of see prices swing one way or the other, but we're not quite seeing that exactly either. So I think it does show that the market is facing a glut, and that is something that traders are looking at quite closely.
Stephen, thank you for the coverage. We're grateful, greatly appreciate it. We'll follow that story into the weekend. Up next, Hugh Van Steenis of Oliver Wyman's going to be joining us. That's next. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session. It's a party. Friday feeling in these markets. Green on the screen across the board. Outperformance in France, which I think is interesting. I would say maybe at the start of the open, we would have thought that Germany would have shown up. The defense trade very much a focus in this market. That's not what's leading, though. It's the CAC Iran, higher by 0.4%. We should make the point, though, that this week, that's where the underperformance has been. So, Guy, it feels like a little bit of a rotation theme in this market.
Absolutely. Let's talk about the internals and figure out what is happening. There's a lot of stocks higher today in Europe. Is Europe breaking out? 426 to the upside, 153 to the downside. The volume is quite high this morning. I'm told it's because of Telecom Italia. A lot of volume going through Telecom Italia this morning, and that is what is driving the high volume today versus the 20-day average. Telecom Italia making some announcement relating to AI. That is giving the stock a huge boost. They're going to be building some extra capacity, some extra data centers, and that is the narrative that is driving that stock to the upside at the moment, and that is why we're seeing it as one of the 52-week highs today, up by over 4%. The Italian market feels like it's very much driving things at the moment. Leonardo in the Italian market as well, in the defense space as well, is also doing fairly well too. It's up by 1.4%. Hensoldt, 52-week high in the defense space, up by 2.4%. It feels like the perimeter of this conflict is getting bigger and bigger and is pushing further into Europe. The fact that Munich airport has had drone incidents tells you that this is getting into the kind of core of Europe. The conflict is broadening out, and that is why the defense stocks maybe are reacting in the way that they are this morning, Kriti.
Absolutely, lots to walk through. Let's walk through some of the other stories you need to know this morning. The all-important U.S. jobs print has been hit by the federal government shutdown. Today's non-farm payrolls report and factory orders data both set to be delayed. It all comes as President Trump vows thousands of job cuts, ramping up pressure on Democrats to end the impasse. In the Spanish banking space, the BBVA chairman and Sabadell CEO have clashed in exclusive Bloomberg interviews. A €17 billion takeover deal would create a new Spanish banking giant and push BBVA closer in size to the country's biggest lender, Banco Santander. We'll bring you more of the interviews throughout the morning. And Bloomberg understands that Bridgewater's flagship macro fund climbed 26.4% in the first 9 months of this year as tariff-fueled market uncertainty boosted the firm as well as its peers. Sources saying the hedge fund is on track for its biggest gain since 2010. The 50-year-old firm has been in reboot mode since Nir Bardea became sole CEO in 2023, making sweeping personnel changes and cutting assets in a bid to boost performance. Guy.
Let's talk about what else we're watching this morning. AI continues to be a significant theme. You've only got to watch what is happening this morning with Telecom Italia making some announcements relating to what is happening with its infrastructure push and the market rewarding it in significant fashion. Bloomberg has also learned that Global Infrastructure Partners is in advanced talks to acquire Macquarie-backed Aligned data centers. Sources say that Aligned could be valued at around $40 billion in this transaction. Bloomberg's Manuel Bagori, who leads our deals coverage in Asia, joins us now. What do we know? Like another massive number attached to an AI deal.
And definitely another mega deal on the horizon. This one seems to be just in the final stretch, and potentially we might see an announcement over the coming days. And definitely AI and AI-related infrastructure, digital infrastructure, and data centers in particular has been a hot topic for deal making, not only in the US, but even here in Asia and globally. We've seen an increase in the number of deals, some of them really large, in the billions. The reality is GAP, now owned by BlackRock, they've been in the hunt for large transactions, and they've also had a really impressive track record when it comes to infrastructure investments over the years. So it remains to be seen how this one will get done, but it appears to be one of the top deals in 2025 for sure.
All right, Bloomberg's Manuel Bagori walking us through the deal environment, specifically when it comes to the infrastructure story. We thank you so much. There's a through line there to our next guest. Hugh Van Steen is vice chair over at Oliver Wyman, joins us around the table. We were just talking to a reporter about the deal-making environment. You have your ear to the ground on all of that, but there are some jitters in this market. On the one hand, people are saying deals are back in the private markets and the public. Others are saying, well, actually, maybe for the next 3.5 years, we should all just be in the private markets. Where do you stand on that?
Well, thanks for having me on, Kriti. Look, I think that it's a very wide and deep market, so you can't just give one theme. I mean, there's definitely a cyclical uptick. And we see this for our conversations with the leaders at the banks. They're very excited about the M&A pipeline, probably more strategic than private in some cases. And I think there's sort of two vectors. One is the strategics wanting to sort of take part. But also, as you saw with the GIP news you're running with, the role of insurance money, wanting to put money to work in infrastructure and data centers is huge. Something like 60% of the new money which came to private credit last year came from insurers. That structurally lowered the cost of capital for private credit. So they're spending way more time looking at infra, data centers, and other asset-backed lending, and much less on leveraged loans, which maybe are going through a slightly tougher period.
Well, that was also one of the concerns around the latest AXA BNP tie-up there, and that a lot of this insurance money, to your point, is suddenly being put to work in a firm that is being thought of as potentially systematically important. Is that a concern, that tie-up, that things are getting a little bit more complicated?
Yeah, well, so we've just put out a report with Morgan Stanley, sort of our annual State of the Nation, and I think our thesis is there is going to be a wave of consolidation across asset management because it's a bit tougher for that squeezed middle. It's the pressure from privates, it's the pressure from ETFs, but also the pressure from investing in tech and AI. And so that squeezed middle, if you're some of the deals in Europe, managers which were less than $1 trillion, it's really struggling. And also the stock performance has been very disappointing. I mean, you were talking about European banks just now, Kriti. They're up 58, 59% in the last 12 months. European asset managers are about up 2 or 3%. So I think the pressure is unrelenting. The challenge is, deals require personalities and numbers to work, and that's the tricky piece here.
Hugh, can I just come back to something you mentioned a moment ago, which is the fact that the AI infrastructure trade is kind of rescuing the private credit kind of side of things, because you don't want to put money over here, so there's an opportunity to put money over here. Everybody's flooding that way. What are the long-term implications of that? How much of this is leverage? How much leverage is going into this trade right now? What do you see the risks around that trade? Like, if everybody is kind of looking for a lifeline, is everybody going to get hold of it?
Well, look, it's a great question, Guy. I think there's two sides to it. On the positive side, there is a capex boom. There is an extraordinary need for capital. Depending on who you look at, 1 to 2 trillion in the next 5 years. And obviously, it's the single largest source of growth for putting capital to work. So I think on one side, it is actually very positive. On the other side, the private credit firms are looking to deploy. One of the most interesting things I've come across is that it's almost in every sleeve. There's the infrastructure funds looking at data centers. The real estate funds are looking at data centers. The asset-backed lending are looking at data centers. Now, depending on who is the sponsor, the one very good one of the themes you've been debating in the last few weeks is this like 99? One of the big differences one of the managers said to me was, unlike in 99 where it was cable and telcos with cuspy investment grade ratings, now it's the superscalers, all of which are incredibly strong credit rating players who want to put money to work. But you're right, there's I wouldn't say a frenzy, but there's an extraordinary race to finance.
But the difference, I would argue, as well, is that when you put cable in the ground, if you don't use it for 5 years, it's still there. If you build a data center and somebody doesn't renew their lease, that's a stranded asset. And what is the risk of all this money flooding in, as you say, from pretty much everywhere at the moment, into an area where we're not sure kind of what happens further down the road? Our lease is going to be renewed. Is everybody going to take up the capacity? Yes, at the moment it feels like everybody's racing towards it and there's big numbers being talked about. But kind of, what is this vintage going to look like in a few years' time?
It's a great question. So what you also start to see in some of the deal structures is actually trying to put in very long-dated leases to actually... So to get the cost of capital down to an infrastructure cost rather than a more speculative property, you do need to then say it's got a 10-year lease. And from a superscaler, that's a very good credit. So I think you're right that there is that tension, but that's why they're trying to get, as best they can, get the terms of the trade to be longer. But you're right, there's going to be... Every loan involves risk. At the moment, they look very low risk, but obviously that's the challenge.
You talk about the pieces of the financial infrastructure that are trying to build this out. What about the client flows and the fund flows that are interested in the people that are investing in this? In other words, where is that interest coming from when it comes to actually wanting exposure to some of these private credit funds?
It's a great question, Kriti. So for me, there's two big themes. So the first we've discussed is insurance. So actually, even over the last 3.5 years, insurers have been the single biggest source of money for the private credit firms, something like close to 60% of the flows. But the second is the growth of wealth. And this is probably, aside from crypto, the single fastest growing area in the market. This time last year, $1 in $9 raised by private credit firms came from the wealthy. This year, it's 1 in 6. And if you look at the way they're putting them together to try and access a broader range of wealthy clients, they're coming in evergreen funds. So like a semi-liquid fund, that space is growing about 40% annualized at the moment. So it's probably the single fastest growing area of the market. and hence why everyone is trying to get a piece of the action.
It's fascinating because it feels like it's a moment in time that's really suiting the private credit folks. And I say this in the broader macro sphere as well. As you're familiar, there's a lot of worries around sovereign debt right now on both sides of the Atlantic. In the corporate credit space, we've talked a lot about how some of the fund flows that maybe would have ordinarily been allocated to that are moving to corporate credit. The second derivative of that conversation, though, is that it might be moving to private credit. Is there evidence of that this early in the stage?
I think there's some. I mean, I've just come from an asset allocator conference this week in London, and I think that, one thing we've spoken about before is that flows are sort of barbelling. So actually some endowments still feel overweight private assets, haven't got the cash back, and actually want liquidity. So they're putting money much more in very liquid fixed income funds. But the other end, if you want to get yield, unless you buy financial credit, which has still got decent yield, you do need to move into private or to structured credit. So you're seeing that polarization going through in asset allocation, and you definitely see private credit firms benefiting from that.
Hugh, you know how the plumbing works. The financial system is epically good at hiding leverage and hiding the connections between the various parts of the financial system to that leverage. What do you see, right? You talk about the insurance money. This should be the safest money in the market, but it's finding its way into areas that maybe aren't the safest place in the market. Where's the leverage? When you look at into the darkest corners of the financial system, what are you seeing at the moment, and what are you seeing in terms of the connections that exist around the system?
It's a great question, and I think this is the first question every central banker asks me at the moment as well. Look, so can I just say there's one positive here. If a loan is coming off a bank's balance sheet and the bank is 10 times levered, and it's moving to a fund which is 1 times levered, or to an insurer which may be 5 to 6 times levered, the system as a whole has got less leverage. But what you're asking is obviously, what are the connections? How do the
risk
points
remain
get joined
with the
up?
bank?
Well, no, it depends. So depends on the loan. If it's a risky loan, the bank is very happy to pass the riskiest piece to private credit and then lend a senior. I think I've discussed this question before. It's like this is where private credit is the Ozempic to the financial industry. It's letting the bank shed weight, and it takes the more senior risk. But on the high quality loans, there is a battle to be had, and so there is a little bit of leverage injecting. The area that you want to chase down would be fund leverage. So it's not just much where an individual is taking credit or loan. It's then is there leverage on leverage, and that's the piece which is very opaque.
Do you see leverage going? How much leverage is in the system at the moment? Leverage tends to undo kind of everything, because you have to mark when it goes wrong. You have to mark it down. How much leverage do you see in the system? Is leverage something I need to be concerned about at the moment?
So, given this trend to insurers and the wealthy, which are less levered than maybe the more opportunistic, it strikes me that the overall level of leverage in the system has been coming down. But fund leverage is the piece where you want to be digging around to understand, has someone taken a position and then levered it up twice with their private bank or levered it up elsewhere? So
when you talk to central bankers, are they worried that they don't have the visibility?
It's the opacity. Yeah, it's that. They want more data. They want to. They feel that in the past they had their finger on the credit pulse. Now, whether they did or not is debatable.
Well,
but they certainly thought they had.
2008
I was about to say that's right, exactly. But they don't feel they have that sense of where the flows are going, and so they'd love to get more data. You just saw, actually, in Australia 2 weeks ago, the regulators now demanding more data from the private market industry, and I think that's going to be a theme we're going to start to see play out stateside and in Europe potentially as well.
Hugh, it's always great to see you. Thank you very much for stopping by to share some of your thoughts with us. Hugh Van Steenis, Vice Chair over at Oliver Wyman. Coming up, Prime Minister Sébastien Lecornu scrambles for allies to push through a budget and keep his government on track. We're going to get the latest on that story next. We'll take you to Paris. This is Bloomberg. Welcome back. We are 47 minutes into the trading of European equities this morning. This is what the session looks like. Volume is actually fairly decent. A lot of that's coming out of Italy. Spanish market definitely on the front foot. The banks there are driving that narrative, and that is why we're seeing some outperformance coming through from that market. We've come up. We're kind of now bumping along the route sideways. We would be normally waiting for non-farm payroll data, but we're not going to have it. So there are other things that we need to be focusing on. Denmark security chief saying that Russia is leading a hybrid hybrid war in Europe, and the risk of further such attacks is rising. This comes as Poland's Prime Minister Donald Tusk warns of an increase in the number of incidents in the Baltic Sea involving Moscow. European nations are dealing with a series of airspace incursions. The latest incident involving drone sightings near Munich airport, which caused a number of flights to be cancelled and diverted. Feels like the perimeter of the Ukrainian conflict is getting bigger and bigger. Ben Sills, our managing editor for the European Economy and Government, joining us now. Ben, Poland saying that Europe is already effectively at war with Russia, and every day it feels like that is increasingly true. The latest incidents just pushing the perimeter of this conflict out further and further. Is that where we now are?
Yeah, I think that's a fair summary. This confrontation, it's not a war yet, but it's definitely a confrontation, has been going on at a low level for a while, and we've definitely seen an uptick in the number of incidents over the last few weeks. And that really, I think, it's reflected in the rhetoric you're hearing from people like Tusk and the Danish Prime Minister Mette Frederiksen. It's also part of their thinking is they need to try to persuade European voters that this is real and this is a threat, because they're spending a lot of money on trying to address this, and that brings all sorts of difficult decisions down the track.
What do we actually look at when it comes to some of these incursions here? From a broader perspective, does it bolster the case in Washington, in Brussels, to have the conversation of longer-term missiles or longer-term striking missiles that does actually have access to within Russia? That was such a sticking point earlier this year, and it feels like there's more consensus on that.
Yeah, there's definitely movement, that's for sure. You know, as you alluded to at the tail end of the Biden administration, Zelensky was really clamoring to be given permission to strike further inside Russia using U.S. weapons. Biden gave him some leeway on that score. He is now pushing the Trump administration to sell him cruise missiles, which would be another incremental but significant expansion of Ukraine's ability to hit inside Russia. And you know, at the same time, the Ukrainians domestically have been developing their own industrial capabilities to produce weapons of that nature. So, and you can see the war now is as much about the strikes behind the Russian front lines in the supply and the energy infrastructure on both sides, as it is about this kind of incremental creeping forwards of the front line on the battlefield.
Can I just talk about another aspect of this conflict, and that is the fact that the French have seized a Russian tanker, part of its shadow fleet, in international waters. Vladimir Putin has called this piracy. What is the response likely to be to this? Is there anything the Russians can do? Is there a response that they can deliver?
There is I think that if you look across the suite of kind of options that the Russians have, and indeed that the Europeans have in what is, effectively like a full spectrum confrontation now. There was a really interesting story from our colleagues who cover the Russian government this week, in which they talked about there's a new Russian law which has come in, which makes it easier for them to sell off assets that they have confiscated. And we were hearing from our sources close to the Kremlin that they envisage that as a way to make it more straightforward for them to seize assets of European companies that are still held in Russia and then sell them off. So that's one way that Putin could actually exert leverage, as well, of course, as just simply increasing the attacks on civilians in Ukraine and turning up the heat on Ukraine, which we've been seeing for the last few weeks, really since that summit in Alaska.
Ben Sills, our managing editor for European Economy and Government, walking us through those dynamics. We thank you so much. He was talking there about the French and the impact there. I want to tackle that from a different angle. French Prime Minister Sébastien Lecornu is meeting with lawmakers for crunch talks as he struggles to pass the budget. The talks could determine not only the fate of his government, but also how Europe's second largest economy tackles its mounting deficit. Our Paris Bureau Chief Alan Katz is all over the story and joins the program now. Alan, just walk us through how realistic and how probable Lecornu's chances are of striking a deal.
I would hesitate to put a number on, his chances. It doesn't look great, I guess, let me put it that way. But that said, in politics, you really never know. I mean, what he's done today, so today he's got these discussions, as you mentioned. He's meeting with the National Rally right now at 10:30 Paris time. He meets with the Socialists, and then he meets with the Greens and the Communists later today. And this is sort of the last chance he has to talk to these people before he tries to actually form a government over the weekend and before Parliament really gets underway next week. It actually started this week, but sort of the main discussion parts for Parliament are next week. And this morning, just before those talks started, he said that he said the government would not use the system that exists in France, which allows you to push through a bill without a vote if you need to. And it's not a concession in and of itself. It's an administrative tool. But by doing so, he does, in theory, empower Parliament to have a lot more control over what is actually in the budget at the end of the day. Whether that's enough to change things, it's really too early to tell. We'll see, I guess, a bit better after these discussions today. But even then, I'm not sure that we'll really know.
Alan, what happens to the budget? We could potentially be heading for a 6% budget deficit. Walk us through what does the next few months look like potentially for this French budget and the possibility of progress? So, at best, it means that there won't be an immediate, because the threat against Lecornu is that he will immediately be censured, lose a no confidence vote as soon as next week, possibly, and be pushed out of office. So, at best, what will happen is he will not be pushed out of office, and there'll be a big, really noisy and unsteady debate in Parliament over this budget. How you get to some sort of actual majority in both the National Assembly and the Senate on a budget is really difficult to see, actually. And this all has to be done in a pretty tight time frame. As you said, the French's budget needs to be done by December 31st, and so that we're actually already in October. So it's really hard to see how this happens. Now that said, because you and I were having this discussion earlier today, if there is no budget in France by the end of the year, it doesn't mean that the government shuts down. What it does mean is that France would have to pass what's called a special law to roll over the 2025 budget into 2026. It's what happened last year. And so it's not going to be like the U.S. There won't be a government shutdown, but we are in for, I would say, at best, a very confusing and noisy debate over this budget. And whether it actually leads anywhere is hard to tell. Great news is we have you to decode it all for us. You're a fantastic team. Thank you very much for doing that. I appreciate the input on that, trying to understand what is happening here. Our Paris Bureau Chief, Alan Katz. The weekend is almost upon us. I know it's only Friday morning, but we don't have non-farm payroll to get through this Friday.
So it's basically the weekend.
So we can focus on other things. I hear there's a new Taylor Swift album. People are talking about it in the newsroom. I have no idea, of course. Paris Fashion Week. There's a lot of sport this weekend, which is good, because I'm going to spend my weekend driving my children around. So you've got the Formula One. I think there's a horse race over in Paris. Chelsea, Liverpool coming up as well. That's my weekend.
Oh, please. The highlight is the new Taylor Swift album, which we both know you're going to listen to.
I'm going to download it. I'm going to listen to it in the car.
You're going to make the references in the morning on Monday morning.
Of course.
That's where this is going.
It won't be a disappointment, I'm sure. Talking of things that won't be a disappointment, Tom McKenzie is going to be speaking with Goldman Sachs CEO David Solomon about the infrastructure impact of AI on banking. That's next. This is Bloomberg.